Welcome back to the REI Hot Seat. Andrew Hines here with Jacob Campanaro, and today we're talking 2022 wrap up. What are the key indicators we need to be keeping an eye on for 2023? Are we expecting interest rates to continue to rise? What are the implications of that? How realistic is it that we're going to get our inflation back down to where it used to be? So going to be a good chat. Jake, thanks for doing this as always.
Yeah, thanks, Andrew. It's always straight to business, eh? Merry Christmas. Let's
Straight
start
to business.
there.
Yeah. So Merry Christmas to everyone. Hope you're enjoying your holidays. And hey, we're not even taking a break. It's the busiest holiday ever. But
It's strange this year, yeah.
Yeah.
It's a very busy one.
Yeah. Everyone's been saying it. Although at home feels like winter wonderland and we got all the decorations up, so that's good. But let's jump into it. So I'm going to be showing several different web pages, sites, things that I've been looking at, just for the key points to base our discussion off of. First things first, our policy interest rate. So the Bank of Canada policy rate, which is the overnight lending rate, is 4.25. Obviously, that's not the rate that you're getting from your bank. The banks have their own spread that they add to that. So right now we're at about 6.45 for prime rate at the bank. So if you're prime plus a half, you're almost 7% now. That's a big ouch to people who started 2022, like, what were they?
1.2?
Yeah, like at high ones,
Yeah.
and now they're ending the year high sixes.
Yeah,
So
yeah. I'll put my hand up,
yeah,
Andrew.
Jake, you're in this
I'm in that boat.
So on his home, variable rate mortgage, thought it was a good
Yeah.
idea at the time. Obviously, the rates were
Well,
fantastic.
I'm variable rate across the board.
Yeah,
I got
so
it on
it's
everything.
hitting you
Yeah.
on these. And it's the question, should I be switching into fixed? And obviously we can't give that answer, but we can give a discussion about the variables
Yeah.
and what you're thinking
And
about
I'd love
doing.
to dive into that, but let's
Yeah.
go through the rest of the market
Sure.
stats first.
Yeah, sure. Okay, so Tim Macklem is the Bank of Canada. He's the guy that's saying all the nonsense and making all the decisions. Anyways, so Tim has said he'll accept nothing less than 2% core inflation. Right now, let's take a look at what our monthly year-over-year updates are.
And
So
we just, this month, we were, down 6.8%, I believe, down from 6.9.
So on trading economics, we're showing 5.8% year-over-year increase for both October and November. Sort of holding a little bit more steady, but inside of that, there's quite a few things going on. It's not as simple as it would seem. Like you might have food going way up and then housing prices coming a little bit down. In this case, housing prices or shelter costs are not going down despite housing prices coming down. And that's mainly because, of course, we've got interest rates on the rise, which is affecting people. And then also rents are going crazy still.
Yeah.
So that's
And
a nice...
what are the rents year over year, Andrew? I know
Yeah,
we were looking
that's a
at that
nice
earlier.
segue into year-over-year rent stats. So December 2022, rentals.ca rental report for the nation. So going through a couple of key cities, looking at a city like Vancouver, these are big cities and they had big rents to begin with. So to think a 20% year-over-year increase, that's insane. That means that the house buyer sentiment dropped enough that these would-be house buyers in a large portion have switched over to renting. Maybe they didn't qualify. Maybe they think if they waited out another year, they're going to find a better price. There's going to be a lot of reasons, which, I mean, if you're an investor, you're trying to time the market, knowing that that big group is there and they might slide back into being buyers is certainly something to keep in mind. So let's look at another city, Toronto, 23% year-over-year increase. So big rents. So Toronto cash flow might be returning if prices keep coming down and rents keep going up.
Yeah, for sure. And what's the tertiary markets looking like? Let's say like London, Ontario.
So London, I would call that more of like a secondary market.
Yeah, secondary,
Yeah, London is the big one. Their rents have been really hit. And I would say their property values have been hit more so than some other places too. They're 31% year over year rental increase. Yeah, over last December, 31%. So what's that work out to be? If you were a $2,000 rental payment last year, you're like $2,600 this year?
Yeah.
Like the same unit re-renting. And that's on average. So you're going to have outliers, some that are bigger, some that are less. Truly, truly wild. Some others like cheaper cities that were cheaper to begin with, like Lloydminster, Alberta, 12.3% year over year increase. Like what's small? Edmonton's only 6.3. Edmonton's typically a slower and steadier market in both housing prices and I guess rentals as well. And then, well, Laval, Quebec, only a 0.8% year over year. So there you go. You want some cheaper rents? You can head over there. Something to keep in mind. So the effect, and I did an episode on this a couple of episodes back, is these rental rates increasing offset some of the downward pressure on housing prices in the multifamily space. So although cap rates are rising, which is the expected return an investor gets pre-financing, with the rent rates rising, it kind of keeps the price relatively the same. Well, obviously there's going to be variance there.
We're still seeing that in the commercial market a lot.
Commercial,
right?
yeah, exactly. Commercial,
we're still seeing
multifamily.
Again, everything is adjusting, but slower because of those rental rates.
Right. The rental rates are helping these investors who have these larger multifamilies, except for the small multifamilies. And I talked about this in that episode. They're just too comparable. Like a duplex is too comparable to a single unit.
Yeah.
Especially knowing that you can add a secondary unit into many properties
Well,
now.
it's just different scales, right? You look at a duplex, a triplex, it's going to be with the ebbs and flows of the residential market, right? So that's
absolutely right. Once you get into the larger multis, they're more differentiated.
Yeah. And hey, that's not a bad thing, right? I want to stress that point, is to say a strategy may be to go buy duplexes, triplexes right now more than the commercial, because when the market does adjust, it's going to adjust quicker.
So you might get a more favorable deal on those smaller ones because the unit rental rates are still pushing those rents up, but the values are coming down. Right. So that could spell a big opportunity.
Yeah.
Yeah. So something to keep an eye on, and maybe you'll see one of those episodes here on REI Hot Seat if you do a little digging. Okay, so next thing that is super important to think about is bond yields. And bond yields are important because that dictates our fixed rates. So we talked about the Bank of Canada overnight lending rate, which dictates our variable rates. Well, this is what we want to look at if we want to look at what's happening to fixed rates.
And Andrew, what's a bond yield? Just to bring it back.
So the bond yield is basically the government of Canada sells bonds, and this is basically how they generate funds. And when they sell bonds, often to the Bank of Canada, they sell them at like, $1,000 bond with a 2% yield or whatever it is. So what will happen is when these bonds trade on the market, if the yield is going to go up, the bond might only sell for $980 instead of the full $1,000. So basically, whatever the market sentiment is for safe funds, which the Government of Canada bonds are seen to be, basically the price of the bond will adjust. So even though the face value of the bond is still $1,000 and the rate of return is still 2% or whatever it is, the yield will change based on what the market demand for that bond is. So that's hope that wasn't too long-winded.
No, and I just, we always throw out some terminology, some acronyms, some things that, some of our viewers may not know or may need to go search. So I thought, let's break it down a little bit.
No, that's awesome. And I wasn't prepared for that. So hopefully that sat well with people. Okay. So
go fact check that and put it in the comments.
Looking at the yield, we've got our Government of Canada. This is a look at the 10-year and the longer term bond rates. Back in July 2022, we were around 2.84 on the 10-year. And we're actually in early December here. So as of December 6th, we're right around the same. We're at 2.8. So we're seeing that the bond yields did come down a lot in the last couple months, about the last month, really, a big dive. And there could be a number of reasons for this. Sentiment, people believe that the rate hikes are going to stop. There's probably a lot that goes into that. But knowing this, these people who are thinking, wow, I know that they're meeting again in January, I'm probably going to bump the rate again because core inflation has not fallen, maybe it's time to look at fixed rates. And I think a lot of people are having that thought right now. I've heard some rumblings about that. I've seen some mortgage brokers giving that feedback that they have a lot of clients that want this. Because if you can get, like you looked up a couple of fixed rates before we got on here.
Well, that's what kind of struck up this conversation, why we wanted to do an episode on this. Because I was talking to you about this exact thing. Because I'm going through this in real time right now. Right? Should I lock in? Do I lock in 2 year, 1 year, 4 year? Right. Yeah. And all these questions. So I thought we could give some advice on that.
Yeah. So, I mean, the big thing is, are you willing to stay? Right? Because with fixed rates, you have something called interest rate differential. So if the market interest rates drop further, then you could be on the line. If you're in a 5-year term, you could be on the line to pay the difference between the market rate when you got your mortgage and the market rate when you broke it. And that could be 5 years of 1 or 2%. So it could add up.
Yep.
And so variable rate doesn't have that, generally speaking. And that's why a lot of people like variable rate. Probably why you picked it in part, because you like the flexibility. And I like that too.
At least for me personally, that's the driving factor to it. Yes, when I got it, the 1.2% was attractive. Don't get me wrong, but I'm always refinancing, restructuring, selling, buying, doing different things. And I didn't want to have to pay those penalties all the time. That's why for me, it was never even a, hey, let's look at the forecast. It was always just go variable. Things will work out. And we'll go from there. Right. And that's why in the case for today, we're just talking about my personal residence.
Yeah.
Right. That's the
only
only
one.
What
rates are you getting quoted for fixed?
So personal residence right now with BMO, I was quoted, and I locked this in a little while back though, and we'll talk about that as well. But I was getting quoted 3 year was 5.4.
Okay.
Yeah.
I just saw on Rate Hub, somebody had an ad, and I don't know what year term it was, but it was like a 4.3 or 4.4.
Yeah.
It was like a mortgage brokerage buying it down. But hot tip, if you are thinking about going fixed rate, you're with a bank already, show them the ad that somebody else has. Say, hey, I see that I can get it cheaper here. And they'll do something for you. In most cases, that's been my experience. Worth doing. At least see what they say. Okay. A thought to Tim Macklem saying we want to get to 2%. I don't think, to me, when I see these lunatics running these organizations. They look like kids like smashing hammers on toys, like want to make that go in, they just smash. It's a very blunt object to just raise interest rates because the market is a balance of supply and demand. Like we have a strike price where supply and demand intersect. And all we're doing is artificially suppressing demand, but it's all pent up now. So that demand's still there. We're just making it too expensive that people, won't buy. So if he's determined to do this and the only tool he's got is interest rate hikes, then that might be a good opportunity for people to just lock in their mortgage at fixed. Because if that is the case, if that's all they're going to explore, my feeling is that it's probably not going to go so well. They might either have to, retract that. And Tim Macklem has contradicted himself. He said he wouldn't even raise interest rates until 2023. He's already done it significantly. So there's that. So they may backtrack and they may not go there. Or if they do it, then we just need to be prepared, and adjust our approach accordingly. So something to think about. Again, I don't have a crystal ball. I don't know where things are going.
Yeah. And here's the thing, right? So the strategy we can use in this market is, okay, so if you want to look at doing a 2-year fixed rate, all right, let's go down a case study here. So we're variable right now. We've been increasing. My mortgage has doubled, more than doubled now with the latest increase. So I'm paying double than what I was originally paying. So I went to just a different bank. I went to a different broker and I said, hey, what can you lock my rate in, right? And when you go with a new bank and you go for a refinance, they can lock in a rate. So I've actually went and did this 2 months ago and I locked in my fixed rate.
Like they give you like a 60-day hold?
Yeah, 60-day hold on your rate, right? As almost every bank
so
does.
It's almost a hedge. Like, maybe you want to do this. If you're with your bank already, maybe get that locked in now and just see how things play out over the next couple of months.
So I locked mine in at 5.5, right? A few months ago, hedging my bet, right? I'm just saying, okay, so let's see what happens now. We have 6 months to sit back and go, okay, is it going to go over 5.5? Is it going to stay under 5.5? And I have a bit of flexibility now to look at that and lock in when I want to, which is, I think, a great piece of advice to anybody who's having the same thoughts and concerns.
Well, it certainly doesn't hurt to give yourself the option.
No, and it's not like you're getting charged to go for a refi. Plus, if I can pull a little equity out, go invest that elsewhere. All right, I'm borrowing now at 5.5. Can I earn 10?
Yeah, you can lend it to me.
Right? So, but if I'm borrowing at 5.5 and I can earn 10, that's 5 profit.
Yeah.
Right? So now I'm refining, fixing my rate, taking a little bit of that capital, getting that to work for me. So there's a lot of little, a lot of little tricks and systems we can put in here. And
for sure. Yeah, there's opportunity. And if you're thinking like, is your mindset opportunity oriented or is it fear oriented? And I don't think the fear is very productive. I think it's important to be aware and then make educated decisions. That's my sentiment on it. So just jumping over to StatsCan Consumer Price Index for November 2022. So you're right, Jake, this other website was wrong. 6.8% year over year was the calculation for November.
That's what I thought. I wasn't going to die on that hill, but
you're all right. You're all right. No, you're good. I should have gone here right away, but they didn't have the chart side by side. So a couple of headlines. So gasoline prices are obviously down month over month, but food is up and increasing slightly faster.
Food is up quite a bit, actually.
Food, I'm really noticing it too, and I'm sure a lot of people are. Just look at the total bill on your groceries, and it's like, wow. And then shelter prices rise at a faster rate, mainly due to mortgage interest costs and rent. Makes sense, something that I would expect. Furniture prices, well, it's good to know that those are slower year over year growth. So a couple other things. I mean, people can look that up if they want. Just wanted to show a couple of items. There was one thing that I wanted to point out just for our reference here in understanding the consumer price index is that it's a deceiving number because it doesn't weigh all the same items consistently. And I wanted to point this out because I was looking this up before as I had heard this, that it was a fact, and I wanted to make sure. Substitution. So the consumer price index as of, I don't know when they changed this. It was probably after the 80s when they had those massive rates. They changed the way it was calculated so that if, say, somebody decides to switch from a nicer product to an inferior product, they'll swap that in the index. Right. So they're no longer tracking the nicer product that people were generally using. They're not going to go track the substituted product. So it doesn't truly reflect all increases in costs. And here's the line right off the government website to confirm that. People change their buying habits when prices go up or down. This means that they may swap beef for chicken to save money, but the data keyword may still reflect the cost of the basket with the original weights for all of the goods, which means they may not. They may or they may not. So this means that they can and they will substitute. So just know that this is why when you've heard me talk about inflation and say, well, it's not really a true accurate number. I knew they were playing with it, but I wasn't sure exactly how they were playing with it. And here, right off their own website, we can see how they do. So keep that in mind. Who knows? Maybe they just, fudge with the number to save face. You never know. No crystal balls here. Yep. So keep setting yourself up. Keep aware with all the stats, but of course, play your own game And I liked one of the comments you had, Jake, and obviously they're predicting a recession, is you said, you were talking to somebody and said, I'm not participating in that.
Yeah.
At the end of the day, the recession is an offer. It's an offer to, hey, are you going to participate in this recession? I don't think so.
Yeah.
I can turn it into an opportunity.
And let's find strategies and tricks and tips and ways to not, right?
Right, exactly.
So,
At the end of the day, it is just an offer. It doesn't have to be the case for everybody.
Yeah.
So that's the part we got to keep our eyes on. So those were the key things that I wanted to go over. Any other sentiments going into 2022? Jake, obviously it looks like in January they're going to give us another rate increase. My vibe is that we're going to see a pretty strong recession in general.
Yeah. I think it's a weird time, Andrew. Like I get this question 10 times a day, right? People say, well, what do I do, right? Where are we going with things? My answer is very similar, which is just 2023 is going to be a weird year.
What would you be bullish on for 2023?
So for 2023, I would still be bullish on the buying duplex, triplex market.
The smaller stuff that's adjusting down and already has adjusted down significantly.
Exactly. Or obviously, if there's a good deal out there, buy a good deal. Like I'm still confident that buying real estate is the best asset you can have. You know what? Some of my assets are down. Yeah. So let's buy to
cost average.
Average, right? We want to, it's just investing 101. Right.
And, like look at the difference. At the peak, like I have a duplex that I just got under contract, might have even touched 1.1 million. I just locked it up at 750. That's how drastic the differences are. I mean, hindsight's always 2020. You can't cry over the way things used to be. Yeah. But knowing that those opportunities are there, that's something to consider.
But just be educated, right? Like if you look at the market we're in, even with the interest rates going up and continuing to go up, look at the stats right now on paper, right? We're looking at it. Canada's come out numerous times now and said we want 500,000 immigrants coming.
Yeah, that's the big. We didn't talk about that yet.
500,000 to our bottom line population.
Yeah.
With an already housing crisis we have. Right. There's not enough rental product.
And this is what I meant when I said, like, they've artificially suppressed demand, but if anything, it's pending up even more than it would have.
And that's my concern. And I think, talk to anybody. That's a very common thought right now. I'm not thinking outside the box here. We need housing. We need housing.
And housing starts are down. Since all this started, this year, housing starts are significantly down.
There was a record number of cancellations and new construction
developers are canceling.
projects.
Why would you want to start a development right now, start building, when you see prices are keeping coming down and construction prices are coming down? Yeah. So there's kind of a perfect storm here, which is why there are some people out there that are still very bullish on 2023.
There's a lot of cash buyers out there right now.
Just looking, waiting.
They're out there and there's
some of them are active right now.
Yeah, they're active right now. And if they can find the right opportunity, they can leverage the market. They'll buy cash. Yeah. And yes, is that to buy cash? Is that a smart investment strategy? No, but they're buying in the market. They're buying the right time in the market.
Watch this channel, watch the other videos. We talk about real live deals. We've gone through the numbers. We've gone through creative financing strategies, how to acquire and buy in today's market and try and make sense of it. And there are ways to make sense of it, like creative seller financing. Maybe the seller's willing to finance you. I mean, there's so many ways to not participate in the recession.
I just had a call this morning with a guy and it was exactly that conversation, right? He goes, oh, we're going to go buy a duplex, but then that's all of our cash. And I said, well, hold on, right? I said, why does that have to be all of your cash, right? And I said, do you want to be spending all of your cash in a downwards trending market? Is that the right decision to make? And that's where we got on the topic of seller financing and down that route. So again, if you have questions, reach out to us, reach out to somebody else, whoever, right? Reach out to a professional in the industry and ask those questions and try to educate yourself best you can.
Of course. Okay. Well, Jake, great convo for today. Great wrap for 2022. It's been fun doing this channel with you this year, and we'll enjoy much more of it into 2023.
Lots of new, exciting things to come.
Okay, guys, support us. Please, if you're enjoying this content, please like, subscribe, hit the notification bell, maybe even share this episode with somebody you think it might help. We'd greatly appreciate it. We're humbly growing here, and we're looking forward to staying in touch with you into the new year.
Anybody wants to reach out, as always, link in the description.
Yeah, link in the description. So Jake does a lot of commercial multifamily, very investor-focused real estate team. They're able to help people get into properties that make sense in today's market. Yeah. But the big thing I love about Jake's approach is, he's willing to say, hey, that's not a good deal, or hey, that's not right, or here's how we'd have to do that. And, that's key. So, all right, guys.
Andrew, thank you.
We'll see you next time.